Hi, everyone. Welcome to another episode of For What It's Worth with Jeff Hedley, and I'm Ben Hager. Jeff, we're almost a couple of months into the year already, and time's flying. How are you doing?
I'm doing good. I'm just trying to stay warm. I think, we're all suffering from this, from whether you're in the Midwest, north to Florida. We've heard about a lot of dropping chameleons, and I heard something on the news the other day. People down in Florida are eating pizza with chameleon meat. That's a
Well,
little weird.
all right. Well, whatever it takes, right? I know it's an infestation down there, so if it solves a problem, good for them.
Yeah, I tell you, it's weird when you start having lizards dropping out of trees. Anyways, let's get into business. Let's stop talking about that. Let's get into business. Earnings season. So we are wrapping up earnings season. We're going to talk a little bit about that. And Ben, why don't you give us a wrap of what we are seeing so far?
Yeah. So I would say really the key message here from the earnings season, as far as where we are at this point, is actually really encouraging. Profits are still growing, but they're no longer coming from just a few names. And I think that's the important takeaway here. We're seeing earnings strength spread across more companies and more sectors. So think of sectors being different industry types, healthcare versus staples, et cetera, which historically creates a more stable and resilient market environment for us as long-term investors. So this is, as far as a key message goes, that's the piece that I'm taking away from earnings so far that we're seeing that is absolutely encouraging.
So and that's interesting because over the last couple of years, big tech companies were responsible for most of the earnings. It got really concentrated, but really how extreme was it?
Yeah. So we've talked before about the similarities maybe between the dot-com era scenario and where we are today with AI. And here's a scenario where actually I'd say the outcome is more extreme than back during the dot-com era.
Oh,
So it was unusually concentrated. Top 10 stocks made up 39% of the S&P 500. And that
wow.
is more concentrated than during that dot-com era. So again, when we've talked about some similarities, I shared last year in many situations that we feel even more encouraged by how this is looking this time around. It's not as bad. That's a scenario where I'd say the outcome looked a little bit worse, or the scenario was looking a little bit worse as far as how concentrated it was getting. But I think it's important that what really mattered wasn't just the prices of the stocks and how concentrated got. Since the end of 2022, which, if we remember, 2022, the most pleasant year, and around October, we bottomed. And so since that time in 2022, those same 10 companies that accounted for roughly 2/3 of the index total earnings growth, I think that's important. That kind of imbalance can't persist indefinitely. It's one thing if they become a big piece of the index, but when they're accounting for all of the earnings growth and the rest of the companies are basically flatlining, that's not a recipe for a healthy outcome over time.
Right, right. So what are we seeing now? Are we seeing anything turn a little bit healthier in terms of the earnings?
For sure. So this is again coming back to the idea of what's starting to feel a lot more encouraging as we move our way into 2026. There was conversation, I'd maybe call it a hope towards the end of 2025, but as we're making our way into 26 and we've heard almost all the companies report for their fourth quarter of 25, the consensus is that this looks much more like a healthy rotation than a warning sign. So overall earnings growth has climbed to a 4-year high of around 14.5%, which, and again, 8 of 11 industries. So again, that idea of sectors, healthcare, staples, utilities, those kind of business sectors, 8 of the 11 industries are now reporting positive earnings growth, and nearly half of companies are growing earnings at a double-digit rate. So the research that I referenced from a recent Bloomberg piece really suggests that we're in a solid overall expansion phase of the economic cycle, which tends to support profits broadly. And we're seeing that show up now, where it's not just those top 10 names accounting for almost all of the earnings growth. We're starting to see, as we've said, if we talk about the Mag 7, we're talking about that other 493 companies that make up the S&P 500. Many more of those companies are now starting to contribute to the overall growth, not just in the market, but in earnings, which ultimately support the prices.
So it's great to see that we're getting this broadening now. Is that showing up in any type of a rotation that we're seeing in terms of the company's performance, obviously the broader earnings? I mean, is AI still a big part of the story for the market?
Yeah, for sure. We can't move away from that. And in anything you read, if you listen to the news, AI is still the headline. Technology companies are still the headlines. At the end of the day, AI is still a very powerful long-term theme, but it's becoming, I would say, more complex. Some companies that were previously prized for being capital light, which means that they didn't spend a lot on new factories, equipment, et cetera, to grow those earnings, are now being forced to spend aggressively just to avoid falling behind. With that, that's what's really led to this rotation into areas that are viewed as more, maybe you call them AI immune things like
Mhm.
utilities, food, mining, construction, telecom. At the same time, the market still depends heavily on a small group of these very large business models. Think of the Microsoft, Google, et cetera, which means I would say any perceived missteps in that AI race could create some short term volatility. Kind of feels like that story recently has moved from who's going to win the AI race, who's going to benefit from this, to who's going to lose because of AI. So a major theme as of late has been software companies. A lot of fear of, hey, AI basically do their job and we don't need these software companies to write code and everything because you can just ask AI to do that. At the end of the day, I would say we're way ahead of ourselves in assuming that no software companies are going to be necessary. But the problem is when you go through a rotation like this, it feels like we just, throw them all out and then we'll figure out the damage maybe later and then truly understand what companies still have staying power. But in the meantime, it just kind of feels like everything is getting thrown out.
Interesting. Very
So
interesting.
with that, I'd say another big piece of this earnings conversation, Jeff, is what's happening to the dollar, right? So the dollar does
Yeah,
have an impact
absolutely.
on US companies as far as earnings. So let's maybe switch that conversation because the dollar is becoming a big part of the investment story. What are you seeing as far as how the dollar is playing a role in folks' portfolios?
Well, Ben, this is one of those obscure economic things that, quite frankly, we don't talk too much about. And largely, we haven't had to for about the past 2 decades because it hasn't been an issue. But it is a
Mhm.
major talking point now, amongst earnings calls, amongst obviously people's view of the economy.
Yeah. So, I mean, why is everyone all of a sudden starting to talk about this now, and what kind of impact can that have on on the families that we're working with?
Well, the simple reason we're talking about it now is because over the last year, the dollar has fallen about 10% in value. And we're getting a lot of mixed signals about why this is happening. And, while this has been a strong positive for our clients in regard to their international investments, in the long term, if it persists, it could have some negative implications for the broader economy.
Fair. So let's maybe break this out and let's talk about how it helps investments.
Well, the first and foremost is when we invest internationally, we have to kind of think about it and that, foreign earnings and returns automatically convert back to US dollars. So when we invest, we have the US dollar, it gets invested, goes into, say, a foreign currency. And then, we want to just say kind of on a daily basis, it kind of converts back to US dollars. And if a foreign currency is stronger than the US dollar when those earnings convert, then they buy more US dollars and hence reflects very positively on our returns. And a great example of that was last year. The German, French, and the UK markets all returned about 22%. I mean, they were right in that range. But as a US investor, not only did we get that 22%, but we also got an extra 10% bump because of that depreciation in the dollar. And the same principle works for an American company that's selling their products abroad. A foreign national can buy more US goods as their strong currency allows them to buy more. And then the American company is converting those sales back to more dollars. So it's a very positive impact both for American corporations abroad as well as a US citizen investing.
So obviously we saw the benefit of that last year. We're already seeing the benefit of that this year.
Yep,
Great
correct.
for American investors and corporations. I assume there's some downsides to the dollar moving like this.
Well, every pro has a con, and some of the the downsides that we see to a weak dollar for the U.S. really comes around inflation, and it reduces overall returns in our market for foreign investors and corporations. In terms of inflation, this can come about as import prices naturally have got to rise to overcome the lost value in the foreign currency. And that higher price for the foreign goods naturally is going to help drive up the cost of US goods as domestic producers have got an incentive to raise their prices to match those foreign imports. And the problem with this type of inflation tends to be stickier than others, and it's pretty hard to reverse. In terms of foreign investors and corporations, which is another problem that we have, they've got the reverse impact on their investments and their sale of goods in the US because they get paid in US dollars. And when they convert those US dollars back to, say, euro, it buys less euros, which means a lower return for them. And this can only go on so long before they start reducing investment of sales or goods in favor of other markets where they don't have this problem.
Yeah, for sure. So, and when we talk about the weak dollar, I assume we've seen this before when the dollar persisted in its weakness for a long period of time. Is it a problem how long this persists, and what did that look like?
Well, it can be like anything. The last time we saw a sustained period of weakness in the dollar was really from 2000 to 2010. This was a great time when US investors and US corporations really benefited from having international investments and sales of their goods abroad. And the main problem we face, though, now with a weak dollar is really twofold. One is that it can eventually turn away foreign investment that we rely so heavily on. And to really kind of put that into perspective, since about 2010, foreign investment has been one of the single biggest things that has driven the growth of our economy. So we don't want to lose that. And the other thing is, it really can be a confidence vote on the US. So, this is just one of the many things that we've got to monitor and pay close attention to, as it can have significant impacts not only on our investment opportunities, but also on our overall economy as a whole.
Yeah. So, obviously, this sounds like it's a much more complex issue than just our investments and, that and how we're tracking this and that what we're looking at for our clients. It also seems like there's opportunities and some drawbacks to these currency movements and how we can position portfolios and our investments for folks because of this, right?
Absolutely. I mean, Ben, we could talk all day about a strong dollar policy versus a weak dollar policy and which one is best.
I said we're not trying to put people to sleep though, right?
No, God, no, we don't want to do that. No, that's for you and I and Dominic to have conversations over lunch. But,
Yeah.
I think that the important thing is that it is one of the things that we look at every day when we're making decisions, for our clients, how we position their portfolio. And more importantly is acknowledging the fact that, is this a longer term trend? Is this something that is just, happening now? But again, it's one reason we're paying a lot of attention to it, and especially how much international exposure we have in our portfolio. But I think rest assured, we're going to keep everyone posted on this, and, we'll continue to monitor it.
Yeah, lots of changes shifting out there from who the leaders are. I've shared this with a lot of people that it kind of feels like we're at this moment of the baton is being passed to the next runner, right?
Yeah.
It feels like there's many things shifting under the landscape. And what's so fascinating about that as we kind of wrap up our thoughts for today, as of today, we're about 2% off of the high from the S&P 500, but yet you hear stories that Amazon is down 22% from its high mark.
Yeah. Yeah.
How's that possible? It's such a big player and a big weight in the S&P 500, just as one example, and that's not the only one. It's across all those big technology names that this is occurring. That speaks to everything we're talking about, changing how the dollar is impacting companies and who's winning, who's losing, changing of who's picking up the baton and carrying that profit growth moving forward. You can definitely feel like under the surface, some things are changing, but on the surface, it just kind of feels like, well, we're just kind of continue to plod along. Obviously, that's what we're here to understand what's going on underneath the surface and if this justifies any changes.
Absolutely. And again, it's just another thing that we have to monitor and look at. But, we're in a world of a lot of change right now, and that's kind of, quite frankly, what makes it interesting.
Yep. No, absolutely. So, Jeff, I guess this is as we wrap it up, and I'll give you a chance for any final thoughts on your side. I guess I would just always say and want to plug anything that's out there that's of interest to you all. Obviously, we can't read everything that's in the news, although we're reading a lot, listening to a lot. If you run across anything that's of interest, please shoot it to Jeff and I. We love to hear from you. What's catching your eye? We can explore it more. We can bring some reasoning to it, or whether it's, accurate or it's just another one of those opinions that's maybe a little flawed that's out there. So please send us information, and we look forward to bringing more information to you next month. But Jeff, any other closing thoughts here?
No, I think, I just absolutely back up what you said. I mean, we try to bring relevant topics every month to the table, but we would definitely like to hear from our clients and what they're thinking and topics they would like us to cover. Please definitely reach out to us.
All right. Thanks, everyone. We'll see you next month.
Stay warm.